the world of high finance can often feel decoupled from the daily realities of ordinary Americans. The machinations on Wall Street and at the commanding heights of the global economy are conducted at such a dizzying scale and mind-bending complexity that it's easy for Main Street to tune it all out as insider baseball. And yet, the tectonic shifts in this realm, obscured behind acronyms and arcane regulations, reverberate through every pocket of the real economy in profound ways, determining the availability of mortgages, business loans, and the cost of financing innovation. The inescapable paradox of financial risk is that the measures deployed to increase systemic stability and prevent future crises are themselves enormously destabilizing disruptions with far-reaching consequences. This paradox is now playing out in the normally staid arena of trading U.S. Treasury bonds and repurchase agreements, the plumbing that circulates the lifeblood of dollar-based global finance. A new regulatory overhaul is about to dramatically reshape this $27 trillion market in the name of reducing excessive risk. At the vanguard is an ambitious gambit by Intercontinental Exchange Incorporated, ICE, the Atlanta-based colossus that owns the iconic New York Stock Exchange, among many other financial market entities. ICE is charging ahead to become a new central clearinghouse for U.S. Treasury trading and the repo market that financial institutions use to reliably fund themselves and leverage their holdings. On its surface, this may seem like an almost comically dry undertaking in institutional plumbing. But lurking beneath are profoundly humanistic questions about the role of competition, the trade-offs between concentrated and distributed risk, and the uneven impacts of tectonic financial reconfigurations. Since the 2008 financial crisis brutally exposed the fragility buried within our ostensibly resilient financial system, the regulatory response has been to mandate more lines of redundancy, diffusion of systemic risk, and transparency. The new rules obligate many treasury and repo transactions to flow through highly capitalized clearinghouses that mutualize losses and act as circuit breakers if a major trading firm goes belly up. This is meant to prevent a repeat of the cascading domino effect when Bear Stearns, Lehman Brothers, and AIG came perilously close to taking down the entire financial firmament amid the mortgage debt debacle. Henceforth, clearinghouses would absorb and segregate the body blows if a single bank went rogue, preserving the reliability of these foundational markets and the overall credit backbone. And there lies the paradox. To reduce systemic peril, we're injecting fragility and upheaval into previously decentralized and flexible markets. The trade-off is exchanging the diffuse uncertainties of the past for newly concentrated nodes of great vulnerability and potentially paralytic switching costs. Without the rule change, I don't know if we would be going in this direction. Chris Edmonds, president of ICE's Fixed Income and Data Services, candidly conceded about the firm's bid to create a new clearing option. Essentially, the reform imposes a heavy tax on the prior organic evolution and emergent arrangements, forcing radical restructuring according to a regulatory prescription. It remains to be seen whether the cure is better than the disease. Historically, there has been only one registered clearinghouse for U.S. Treasury securities, run by the Depository Trust and Clearing Corporation, DTCC, which foresees over $4 trillion in additional daily clearing activity by 2025. Now, in comes ICE with designs to build out a parallel option from scratch. The Chicago-based CME Group and the London-based LCH are also awaiting regulatory approval amid rising expectations of future clearing capacity constraints. We are deliberately destabilizing and reordering core financial infrastructure that annually processes over quadrillions in transactions and funds U.S. government deficits that now annually top $1 trillion even absent recessions. Yet ICE is unabashedly charging ahead, sensing a ripe opportunity to seize commanding territory in what could become a lucrative new market. We believe we can provide a compelling alternative for those seeking to have more than one option in the market, Edmonds asserted. To bolster this ambitious moonshot, ICE has been staffing up with hires like Paul Hamill from the trading firm Citadel Securities to steer the undertaking. There's no denying the contrarian entrepreneurial spirit on display here. As often happens, the invisible hand of profit-motive dynamism is trying to surge ahead of the regulatory dietzutats and arbitrage the new rules. ICE's gambit surely seems audacious, if not hubristic, creating a second clearinghouse option for a multi-trillion-dollar market that has never truly required one before. And yet, according to Chris Edmonds' own candid admission, ICE might not have pursued this path if not for the clearing mandate. So is this bold innovation, or merely compliance workarounds? The distinction matters for assessing whether we're truly diversifying clearing capacity and risk dispersion, or just self-interestedly crowding a massive scale of new flow into parallel private toll booths. The systemic solidity being engineered depends heavily on behavioral adjustments and incentives. If major dealers flock to the new ICE option purely for cost savings or narrower commercial interests, we could witness damaging herd behavior, the very risk-concentrating dynamics this whole exercise aims to diffuse. On the other hand, if executed responsibly on behalf of the public good, the entry of new clearing options could indeed reinforce stability by dispersing risk nodes and injecting more operational resilience. Healthy competition will ensure readier capacity buffers during bouts of severe market stress. Yet we must be perspicacious about how that competition unfolds. Remember, the excessive risk-taking and shaky dominoes that eventually imploded into the 2008 crisis incubated over decades amid a complacent status quo buttressed by consolidation. Do we end up with a handful of systemically crucial choke points that become too interconnected to fail? Do we witness fee gouging and rentier dynamics if a new oligopoly crystallizes? And what of the inherent risks and elevated switching costs of fragmenting flows across parallel market utilities, each with its own siloed rulebook, compliance regime, and technology platform? Seamless resiliency is hardly guaranteed. These concerns over emergent dynamics and second-order effects are no idle theorizing. We need only look back to other recent episodes of systemic reengineering undertaken with sincere intentions to mitigate risk. Take the advent of centralized clearing parties, CCPs, for the global derivatives market in the aftermath of the 2008 crisis. Intended to concentrate and diffuse risk away from megabanks, we instead witnessed a furious reconcentration of counterparty exposures among a few systemic clearinghouses, albeit breached by more loss-absorbing capital buffers. Dealers quickly gravitated towards the handful of dominant CCPs, and regulators acquiesced to consolidation under the flawed mindset that fewer, larger nodes are sturdier nodes. These secular market shifts entrenched new too-big-to-fail hazards ripe for regulatory capture and governance challenges. Similarly, recent FDIC research on reforms enabling institutional prime money market funds to impose redemption gates revealed inadvertent distortions. Fund sponsors shunted liquid asset holdings into separate tranches walled off from other portfolios, incubating new channels for severed liquidity to escape the very contagions the new rules aim to suppress. Endemic to so many well-intentioned regulatory revisions are similarly unintended consequences. Market participants contort to optimize new incentives, while regulators scramble to address new seams, workarounds, and arbitrage. A ceaseless cycle ossifies, as stopgap reforms sow the seeds of complications that demand fresh reforms. We must be vigilant that these serial restructurings don't engender self-reinforcing bureaucratic metastasis, amplifying system fragility in subterranean ways. Perhaps the Treasury and repo clearing overhaul could puncture that doom loop. After all, it represents one of the rare instances when reformers had a relatively blank slate to architect anew and invite fresh entrants from the outset, rather than layering new patches atop ossified incumbents. If executed smartly and governed judiciously, the clearing influx from fresh venues like ICE could inject dynamism, forcing incumbents to become more nimble while diluting monolithic risk nodes. Competition fosters accountability and responsiveness to evolving needs and threats. A multiplicity of clearing paths and models also injects vital modularity into system-wide failure scenarios. After all, no matter how astronomically remote the probabilities of outright market implosion, we cannot predict the unpredictable eventualities that constitute true black swan cataclysms. Unforeseen shocks will inevitably defy our best models. When existential contingencies strike, dispersion and multiplicity are the ultimate psychological failsafes. To that end, let us hope the spirit behind ICE's bold gambit is more than just hungering for another revenue stream. Their endeavor should be executed with genuinely civic intention, to provide legitimate counterweight and diversity that reinforces the resilience of systemically crucial financial arteries. The true dilemma, however, extends beyond the mechanics of clearinghouse expansion. Burrowed beneath these crucial reforms lie even more vexing questions about the inescapable hypercondensation and homogeneity suffusing global finance. As interconnected markets become more institutionally concentrated and complex, the paradox is that immense regulatory scaffolding is required to manufacture credible safeguards, redundancies that ultimately amplify interdependence across fewer systemic nodes. This engenders its own risks of herding, groupthink, and channel liquidity crises if those critical pipes constrict. We are left to ponder whether the hyperfinancialization and abstraction of 21st century capital markets renders the entire system more crisis-prone by its very architecture. With oceans of securities flowing through identical quantitative models and risk management frameworks operated by a thin cadre of hyper-empowered intermediaries, the scope for deracinated liquidity holes and mass conformity glitches looms ever larger. Contrast that to prior eras when financing flowed through more regionally dispersed nexuses, each embodying unique models calibrated to local knowledge and decentralized prices rooted in deeper fundamentals. The ruthless efficiency of contemporary capital market plumbing has rent asunder the ancient wisdom of segmented inefficiencies. Back in the 1980s and 1990s, fewer asset classes were seamlessly fungible or rendered into insta-securitizations. Credit markets were comparatively balkanized across various collateral types and funding currencies. Even as globalization advanced, significant pockets of heterogeneity persisted, which compartmentalized shocks. Today, everything is spun, rehypothecated, and interwoven in ways that defy comprehension. All silos ultimately converge, and cross-asset volatility correlations intensify. Tectonic shifts in any systemic crevice rapidly reverberate through every tangential cog. Risk concentrations ferment even amid ostensible diversification. Therein lies the haunting quandary for policy stewards and brave market pioneers like those at ICE: how to preserve the dynamism of 21st century financial innovation and sophistication, while mitigating its insidious propensity to foment secular instability. Do additional clearing venues bolster resilience, or plant seeds of new fragilities? There are no perfect solutions, only eternal tensions and trade-offs to navigate between concentrated and diffuse risks, systemic and idiosyncratic dangers. As ever, those who dwell in the financial arena must maintain eternal humility about unappreciated hazards cloaked within their ingenious architectures. Audacious entrepreneurs like those at ICE deserve respect for their willingness to disrupt existing hierarchies. May their plucky forays shake up the staid customs and complacencies of old financial paradigms. At the same time, we would be wise to maintain skepticism about whether their disruptions enhance system integrity or merely shuffle hazards into mutated variants of the same fragilities. True reformation is rarely as straightforward as it seems. The gravest pitfalls are those we fail to anticipate amidst the shiny veneers of innovation. All progress incubates unintended consequences lying in wait to disrupt the future disruptors. No financial cathedral is too majestic to resist entropy. As citizens, we must maintain vigilance against those who peddle silver bullet remedies to mitigate risk while enriching themselves. Most existential threats cannot be eliminated, only rebalanced and reconfigured across new geometries until the next seismic shift. Enduring robustness flows from diversity of ideas, of models, of people. The latest evolution in treasury clearing is notable, worthy of regulatory engagement, and deserving of democratic accountability. But in our eternal quest for firmer systemic footings, its impacts will be ambiguous, contingent, and subject to ever-evolving circumstances. Financial progress is a voyage, not a destination. Ceaseless innovation coupled with humility is the only prudent course.